as you said, because we have a number of people who represent different aspects of the model. So we have a couple of people who are very much into early stage investing. We have another venture studio participant, and we have someone else who's more involved in later or growth stage venture. So I think we should get a great mixture of perspectives. So the kind of broad framing of this is really to look at venture in 2021. And obviously we're coming off the back of a very interesting year. So I think what we're going to talk about a lot is how that's changed venture capital and kind of what our outlook is going forward. So I'm going to ask, first of all, the participants of the panel, my panelists, just to go around, very briefly introduce themselves, their firm, and their kind of focus area, and then we'll loop back around again to kind of dig a little bit deeper. So I know Brynne is not quite here yet because we're a little ahead of schedule. So why don't I go to Sylvia, do you mind kicking us off?
Not at all. Can you hear me okay?
Yeah, you're fine.
Wonderful. So hi, everyone. My name is Sylvia Kim. And before I talk about my firm, I like to say, I have a bit of an unusual trajectory into venture. So I don't have kind of the usual investment banking background. My background is actually in international human rights law. And after 15 plus years of advocacy and frontline work, I actually moved into venture because of my fundamental belief that sustainable impact is found at the intersection of technology, innovation, and access to capital. Currently, I'm a venture partner with CerraCap Ventures, and I'm also the general partner of CerraCap Cares, which is our impact fund. CerraCap is an early stage venture capital firm investing in only 3 areas of technology that use a B2B strategy. So our 3 areas are enterprise AI, cybersecurity, and health tech. We were founded in 2015 and are based in SoCal. And I would say that our 3 unique differentiators are: 1, we like to mitigate risk through what we call our sales and scale model. So while others make introductions, we have a unique ecosystem where we can drive purchase orders and revenue into our portfolio companies that highly mitigate risk for early stage companies. Our second differentiator is that we have a very proprietary deal flow when it comes to those 3 areas of enterprise AI, cybersecurity, and health tech. As an example, a lot of people know that Israel's 8200 unit is what is the source of some of the top cybersecurity companies in the world today. And one of our companies, Deep Instinct, comes out of Israel. We also have a global portfolio. And lastly, we like to say that investment is a science, but liquidity is an art. And because of just our unique ecosystem, we've been able to liquidate a lot of our deals at a much faster rate than the average venture capital fund, which is why we've been top performing. And we're proud to say that for Fund 1, we're in the top decile for our performance. Fund 2 has not been benchmarked yet, but we're anticipating that we'll also be top decile. And we've just launched our 3rd fund.
Fantastic, thank you. Joe, you want to go next?
Yeah, sure. Is the audio doing all right? Just getting set up here. Okay, great.
Doing great.
Well, thanks for having us. And Sylvia, thanks for kicking us off on this chat. My name is Joseph Hasselman. I'm a managing partner at a firm called Invicta Growth. We launched in 2019, effectively on the heels of an anti-portfolio that was getting a little bit too large for our comfort. So started investing in enterprise software companies. Then my background prior, a number of operating roles in Silicon Valley, and prior to that, started with IBM's Watson Group during the launch in 2014. So our strategy at Invicta Growth encapsulates a lot of that background and experience in enterprise automation. We invest throughout the life cycle of these growth stage businesses, again, B2B software, typically with a high level theme of enterprise automation. And we consider ourselves a modern investment firm, and it sounds like that'll be a core topic for us to discuss today. And what's really important to us is both velocity and insight. Happy to dive into the specifics as we go on here, but that should set the stage for the perspective I'll bring to the table.
Thanks so much. And Priscilla?
Hi, everyone. Thanks for having me as well. I'm Priscilla Guevara, and I'm with a firm called Science. We are an early stage venture fund and also now kind of playing a barbelled investment approach. We're based in Los Angeles. We focused on consumer tech and internet companies that are highly disruptive. As Jeremy had mentioned, in terms of other platform studios, we are a studio, and that was how we actually entered into the space of venture. We've been around since 2011. And really the idea is we want to work with early stage entrepreneurs, helping to scale them and helping to grow and find the exits that they want. In 2011, we were seeded by Hearst Corporation, so we have very strong ties to corporate conglomerates and multinationals. Maybe the kind of claim to fame here is we incubated Dollar Shave Club. We sold them to Unilever within 4 years for $1 billion cash transaction that really laid us on the map in LA. And also in the sector of CPG. So kind of where we play is consumer packaged goods, mobile media, and also marketplaces. In the marketplace space, we had a company called FameBit. We sold them to Google, YouTube. We had Hello Society, sold them to New York Times. Again, kind of raising the stakes there. To date, as I mentioned, we have a barbelled investment approach. So we have early stage venture funds that are institutionally backed, such as State of Michigan Retirement System. We're going on Fund 3 now. We have co-investments and direct follow-ons. We also have late stage SPV externals. And we also launched and priced our first SPAC. So for those of you, the SPAC conversation just prior to this is quite relevant and certainly resonated. So I can speak a little bit to that at a high level, but I'm sure that we'll dive in a much deeper level. So thanks so much.
Great, thank you. So just to sort of recap in my opening, what we're here to talk about is the outlook for venture going forward in 2021 and beyond. And just to frame that, there are a number of meta trends that predated COVID. Obviously, ESG has been a big and continues to be a big trend. DEI, the kind of focus on blockchain and crypto continue. But I think also there are some specific meta trends driven by COVID itself, like the kind of decentralization of the ecosystem. So maybe I can actually start with Joe. I mean, as you look at 2021 or what's left of 2021, what are the big sort of trends that you're seeing? What is different as well about 2021 versus 2020 or before?
Yeah, I think at a high level, the theme and the trend that we're seeing is that it's this critical moment of impact between the state of technology and enterprise adoption. I think what last year served as a reminder of is, one, the pace of innovation, but it also pulled forward these years of adoption for a myriad set of technologies. Cloud, certainly, intelligence, certainly, some of these decentralized applications, grassroots efforts really took off. But what we're really fascinated by and are studying very acutely is the conflicts of these three variables, which we see as more capital coming into the private markets. This is a product of both venture performing extremely well and a low rate environment, with all of the trends that we're familiar with, companies staying private longer, less public companies listed than there have been in decades. So that's number one. Number two is what I mentioned, is the state of technology. A lot of these trends that we've seen over the last, call it 5 to 20 years of shift to the cloud compute, to intelligence, to digital operations, is at this high momentum moment. And then three is the imperative for organizations to be digital first. And that's the trend that really was pulled forward last year. As you can see with a lot of these highlight reel companies like a Zoom or a Snowflake. But at the conflicts of those three, I think is really the meat of this conversation. Why is the venture market moving so quickly? Why is velocity so important? It's because of those three attributes. And I think what we'll reflect on in the coming 5 to 10 years, thinking about this time and investing through this moment, is what insight really helped us discern the myriad of opportunities that are out there with those that are going to really take a grip to be the winners.
Great, thank you. So I think Brynne is here now. So Brynne, why don't we do a twofer? If you can maybe give you a quick intro on yourself and your firm, and maybe you want to riff on the question of, how is 2021 looking and how is it different to years past? You there, Brynne?
I think we might need to move Brynne from attendees to panelist.
Okay, all right. While that happens, and as you're speaking, do you want to go, Priscilla, and give us?
Sure. Yeah, I mean, I can speak at it. I mean, I certainly agree with along the lines of what Joseph had mentioned in terms of, the tech innovation. I think what we've seen are a couple different things. If I started with consumer, one of the big trends that I think we've seen is this kind of idea of authenticity over authority. So when consumers, and especially millennials and Gen Z, are looking at purchasing products, they are looking for something that they can really connect with. And kind of what that means is not only are they able to connect, it also means that consumers are then becoming less price sensitive, thereby driving much higher margin opportunities. And so that's kind of what we're seeing on the consumer side. Again, kind of touching on the digital innovation, what we are seeing is obviously this new disruption amongst fintech. And again, we see NFTs in the blockchain space. We've had a blockchain entity since 2017, which we can kind of dive into later. But I think what we're starting to see is that. And the second, and I would say that maybe the third, is really this idea of the emergence between private and public markets. I mean, I'm sure we touched on that in this last SPAC, but my prior work in hedge funds and also asset managers, I'm starting to see them actually play more into the private markets, understanding how they can get in much earlier, and also understanding what the new trends are at the earliest stages. And I think Sylvia had mentioned this as well in thinking how we invest as a science. That's one of the things that we've also been using, and that's really the name behind us. We're not in life sciences or healthcare, but we do take a data-driven approach into how we think about investing. And so as part of that, it's how do we utilize our internal insights, the trends in the markets of where consumers are going, and we use that to drive our investment decisions, both at the early stage and also kind of at the late stage as we enter into public markets. And then kind of, I would just maybe say one last piece, I guess, in terms of where we see the market going, going back to kind of that authenticity. We are starting to see, those stats around, there's only been 2% of capital, venture capital going into for women founders. And so that's kind of what we're also seeing, that shift is elevating women and understanding that they need to come to the table. And it's both from women founders and women funders as well.
Great. That feels like a great segue to you, Brynne. I think you're fully enabled now.
I think I am. Is that working all right?
We can hear you fine.
Okay, great. My name's Brynne Kennedy. I am a venture partner at Impact Venture Capital. We are an early stage AI focused fund. We look to back entrepreneurs building exceptional companies and disrupting what we define as foundational industries. So heavily focused on security, healthcare, and fintech sectors. We typically are the first institutional investor into a company, and we support our founders in getting to their Series A, their Series B, and beyond, and supporting them through that journey. Our big differentiator is that we have a very robust network of corporate venture partners and corporate innovation department partners. My partners founded the fund after running Oracle's venture arm. So we know the corporate venture market really well. We leverage this network to help our companies scale their go-to-market, help with follow-on investment, and ultimately help them achieve exits. And I think expanding to the trends for VC for 2021, I think one of the big ones is, and we see this every day at Impact, is that corporations are really looking to innovate. They're looking to startups, they're looking to venture investors to drive growth and change in their businesses and to tackle disruptions that they're confronting. And that's a core part of our model, is partnering with those folks to understand where they're looking to innovate and then drive our investment strategy from that. Piggybacking on what Priscilla said, I think we also see huge disruption in the fintech markets. My partner Eric was on the prior SPAC panel and is heavily involved in our fintech portfolio companies, but everything from blockchain and crypto and the use of that in fintech businesses to disintermediation of bond offerings. We've got a portfolio company focused in that space. It's all very, very exciting, and I think an area that we really like. Finally, I'll finish with, we do a lot of deep tech investing. One of our portfolio companies that's farthest along and most exciting is called Konami. It is a confidential computing or homomorphic encryption company that allows for the processing of large data sets while still fully encrypted. I think security and the management of data and the ability to analyze big data sets with confidentiality taken into consideration is another trend that we will increasingly see.
Great, thank you and welcome. Sylvia, do you want to opine on this question of 2021 trends and beyond?
Yes, absolutely. So I think that, I agree with what Joe and Priscilla has been saying. 2020 was really a marquee year for venture. And so I think we all know that we've entered 2021 with kind of the most dry powder ever. And, venture is really being looked at by kind of maybe even new investors that have never considered venture as an asset class. And so I kind of feel like it's this seminal moment for venture capital. At the same time, there are these massive trends that are happening, I think, in the industry. Silicon Valley is no longer, I think, considered the true epicenter of all innovation in tech. It's becoming much more global, more equitable. There's all these different hubs popping up, whether it's from Miami to the Midwest. And I think investors are seeing that there's this diversification of innovation. And similarly to what Priscilla said, I really resonated with what she said about authenticity from a B2C model. I also feel that perhaps with my background in international human rights and now also kind of developing and launching this impact fund for CerraCap, that missional alignment and being mission driven and kind of incorporating ESG trends, which now there is enough data to say that, that does provide financial returns, that women fund managers provide returns, this DEI kind of concept is here to stay. I think that that's kind of an interesting phenomenon that's happening just as venture has all this dry capital and all this kind of new appetite and interest. And so I think that 2021 is going to be a very interesting year. I mean, we've already seen in Q1 that I think we're already at like 64 billion, I think in Q1 of capital raised. And I think that's 40% of all that was already raised in 2020. So I think we're on track to have another marquee year, but it'll be interesting to kind of see that in conjunction with these trends on the missional authenticity side and how we kind of embrace DEI, ESG, and missional kind of impact investing. And, I think that the model that CerraCap has where, on one side, we have a very high performing venture capital firm that's kind of on the most innovative technologies, where on the impact side, we're looking to embrace more of the ESG trends. I think that might become more of an kind of a trending infrastructure for funds. We've already seen a lot of different funds that are launching these impact funds off of their platforms. But as we do that, I think there's also the concern of impact washing and greenwashing and, everybody and their mother claiming that they're an impact fund. So that'll be interesting to see how that all plays out. But I do think 2021 is going to be a seminal year, and hopefully one that also really establishes some of these kind of DEI ESG trends, and also ensures that there's more than the 2% of funding that went to women founders this year.
There's a common thread that you're mentioning, Sylvia, with Priscilla, what you mentioned in authenticity. When you look at the venture market, and the way that people have dispersed, working across their various cities, when you look at the solo GP trend that's occurring, particularly at the early stage, and you look at kind of the fractionalization of the industry generally, I think authenticity is that underpinning, perhaps dynamic that's enabling this next generation of diverse founders and diverse funders to participate in the marketplace in a way that hasn't occurred historically.
Yeah, I think it's also a recognition that great companies can be built anywhere, and great founders and CEOs can be from anywhere and look in any way. I come out of the operating side. I was a founder and CEO for about 10 years. I built an HR software company, and I originally founded it during business school in London and raised money in Silicon Valley. And I will tell you, 10 years ago, it was very, very difficult to raise funding for a business that was not based in Silicon Valley. Today, we see this great decentralization across the country and the world of venture investment, and this great embrace of much more diversity in founding teams and in fund managers. And I think that increases probability weighted returns and frankly is very good for society.
Can you hear me?
Yeah, we can.
One sec.
I'm not sure if that was an intentional. I want to pick up on this authenticity. So, I mean, I think I 100% agree. And I think clearly these ESG measures are starting to kind of yield actual data that they deliver better returns. But when it comes to authenticity, how does that change specifically your outlook and your role as a venture investor? Is it, I mean, presumably it's not just simply targeting more female founders, or it's got to be a kind of more holistic change than that. I'd like to understand a bit more about what that actually means in terms of how you do your day-to-day job.
Yeah, and I think what I had mentioned, right, on the consumer side is finding those mission-driven founders that are behind a mission, but also where they're very authentic to a brand. So if I gave an example of a company that we incubated back in 2018, and now you guys can probably see the latest news of their latest partnership, and it's a company called Liquid Death, and it's canned water. And it's so authentic in the sense that these were two founders who all tatted, wanted to go to these punk rock metal concerts, but only could drink, and they also don't drink, and they wanted to find water and something healthy. They could only find Red Bull energy drinks. They found water in plastic bottles. And they said, you know what, I am vegan, I'm plant-based, I want to find and get rid of plastic in the world. And so what they did was they actually came up with this highly disruptive canned water that looks like a beer. So you can go to a concert and still feel cool, removes the stigma, but you're also doing good in the world. So I think from that sense, it's good for the entrepreneur to be authentic to themselves. And if I could repeat what I had mentioned earlier, is that consumers are identifying with that same idea. They're becoming less price sensitive, and they will pay the $2 because they know that this is something that they truly like. And they will go to the 7-Elevens and they will choose this canned water over a Poland Spring. And I think that's, you know, at the end of the day, from a venture perspective, if we're thinking about it from an investing standpoint, it creates these higher margin opportunities. So just that, and we now know, I mean, Liquid Death will now be the fastest growing beverage in history and will be named this year. And so we'll start to see kind of these, you know, 3 billion type exits over something that you would never have imagined previously. So I think, you know, that's certainly one way that we're seeing investments become a lot more authentic.
I think as a venture capital, and I appreciate that, Priscilla, actually, that's amazing. I've been seeing all the press about Liquid Death. I think as a venture capitalist, and perhaps because I don't come necessarily from kind of the traditional background, I think it's been really critical to also redefine value. So, you know, one of the things that really drew me about CerraCap was, you know, everybody, you know, is fighting to get a track record. You know, there's like a venture capital firm on every other block, it seems like, or a new one cropping up. And I think it's time to also kind of redefine what value venture capitalists kind of bring to the table. And I think, you know, it's this concept of it's more than just capital, right? It's a lot of, and then it's not just introductions. It's like, how can you define value? And I know that for us, we define value as revenue into our portfolio companies. And that is just tangible, that is concrete, that is repeatable. And I think that is authentic. And I think that helps sometimes when we really put these more measurable kind of outcomes attached to what value we bring. Similarly, on the impact side, you know, everybody's like impact, UN SDGs. I come from that world, and I can tell you that it is very intangible, and there is no universal standards to measure impact. And so the way we framed our impact analysis is, how does your tech-enabled platform actually reduce disparities for the underserved, which we define as those that have been systematically discriminated against. And so an example of our first impact investment is an incredible company called Aquagenuity. It was founded by a female founder from Atlanta who was moved after Flint, Michigan. And she just wanted data to the people. She felt that, a lot of these underserved communities don't have access to these fancy technologies that exist in Silicon Valley. And so you can actually go to her website, put in your zip code, and her data architecture will spit out a score and tell you what contaminants are in your water. And so those are the kind of, I think, concrete measurements of impact and concrete definitions of value that I think lend to more authenticity.
I think piggybacking on that, this is Brynne. I think it's also really important as a venture investor to use pattern matching to drive good investments, but also be really diligent and rigorous to ensure that the pattern matching that you do doesn't direct you into limited diversity. When I was an entrepreneur and a CEO, I heard so many times across the other side of the table, well, we pattern match, we know what great founders look like, we know what great companies look like. And I'll tell you, 12 years ago, most of those great companies that had achieved an exit were male, and they were white, and they were a particular age. And I think that it's just really important to have eyes wide open about that, fight against the unconscious bias or what the pattern might necessarily spit out with respect to diversity, so that you can bring more diversity into the portfolio. A good example of this at Impact Venture Capital is, again, the company I mentioned previously, Konami. The CEO of that company is in the later stage of his career, incredibly accomplished gentleman, many patents, many successful exits under his belt. But in the sort of typical model from a decade ago, most of the money was going into founders who were of a particular age or earlier stage in their career. And that's a company where we took a bet. We've significantly supported the company, and it's going to be transformational for the world and doing incredibly well.
Fantastic. So we have a question from the audience here that kind of piggybacks broadly on this question. So I'll just read it to you. So Alex, thank you. So the question is, how much does background and character and values come into play when evaluating founders for venture investment now? Does bad behavior and toxic character factor greater in funding decisions? I think, from my perspective, I summarize what I'm looking for in a founder as smarts, goodness, and grit. So goodness is definitely a key part of what I seek. Any of the panelists kind of want to opine on this question?
I'll take a stab at it. I think what I've learned over the last 18 months of building Invicta is that there are so many relationships to be made in the market. There's so many founders. There's so many funders. There's new opportunities to build relationships in any given moment. It needs to feel natural. I think there needs to be an inherent alignment in what you're trying to accomplish. There needs to be the value met with the need. And I think that boils down to a couple of these topics you mentioned, Jeremy. Goodness, some of the past experience. Certainly, you want to hear the story of getting to where they are as a founder. So much of venture is driven by narrative. But I think more than that, it's you creating a story that you want to support, and driving that home through that support and through that alignment over time.
I mean, I would also add to that, and I 100% agree. And I think one of the things that kind of makes us a bit unique, right? We have a studio model, which allows us kind of this time and ability to really work as a portfolio operator with these early stage founders, really to evaluate, not only are we de-risking it as an investment for the fund, but it also allows us that flexibility to get to know a founder, get to know their personality and their drive and their work ethic before we truly make those first dollars into their company. So I think it's certainly very, very important, because what you see through, especially at the early stages where you're going off of an idea and you're going off of maybe an introduction, you don't really know until you actually spend time with someone. And so really working with someone to get them from 0 to 1 and going through the ups and downs with them will really allow you to get to know their background, get to know their character, and to your point of all the values that are in play before you make that first investment.
Priscilla, it might be, it's obviously close to my heart. this might be a good opportunity just to talk briefly about the studio model, where you think that adds value, and kind of what the relationship is at Science between the studio and the fund side. We don't have to get into the nitty-gritty of the legal setup, but just kind of, relationship-wise and value-wise, how do those two entities coexist?
Yeah, I mean, to the point, Sylvia spoke about this in terms of, pipeline. I think what we also utilize the studio for is it's utilizing three steps to get into our studio. It's really working under our thesis, utilizing our network, inbounds as well, and also that complementary synergy of working with these early stage founders who are looking to solve a problem, but really want to find niche experts to really help them get to that next level. So what we found is that a lot of founders, let's say there are maybe two founders who are strong engineers who have really great financial operations behind them, but really don't understand kind of that sector expertise. They really want to build an e-commerce. So they're coming to us because they want to solve that problem and know that we are the ones that can actually help to scale them. So I think where we play, and in terms of like the value add that we bring is, my partners have been historical operators and investors. Mike was the CEO of MySpace. He was a company, he was powering chatbots that was sold to AOL and basically ran AOL's instant messenger group. So I think from that lens, you're stacking a team around founders that allow that expertise to get you from 0 to 1 very, very quickly. And then also, I mean, it does touch on DEI, because a lot of times too, especially we have, in our portfolio, we have about 65% of our capital went to diverse and or underrepresented founders. And it wasn't by choice. It was, we've been doing this before even DEI was even a thing amongst investors. But what we found was that these founders were not able to get the dollars in. And the reason being, it's the Series A, Series B, that's not the tough part. It's those really first dollars to get them on the map. And where we've been able to help is actually forming a strong business model around these founders, helping to stack the right network around them, getting them to form strong metrics that make sense for their business models. And again, utilizing our network to make sure that they have strategic partners to get them through to making sure that they get the exit that they want.
Does anyone else on the panel have anything else on this topic? Otherwise, I have a sort of change of direction into a more of a structural question about venture. All right, let's do it. So I think one of the other things that's been kind of interesting to track recently is we've seen some of the later stage and sort of PE companies starting to come down into early stage. Particularly Tiger has sort of made some headlines with sort of suddenly saying that they now want to do early stage venture investing. What do you think about this trend? Is it a kind of a big ongoing trend that we're going to continue to see more of? Is it just headlines? Maybe Joe, I know because you play more in the later stage, you want to opine on this one.
Yeah, it's a good question. My prior role to Invicta was I was on the early team at Forge, and my main role was standing up our institutional client group, so working with global asset managers, hedge funds, and various allocator categories, and helping them predominantly, as you might know, Forge focuses predominantly on secondaries, but broadly speaking, just access to the venture asset class. And what was interesting to see is throughout my time there and more historically, if you look at the composition of players in the venture ecosystem, it went from VC firms to it went around the Facebook IPO, the mutual fund participation was net new. And then you look into this next iteration, and hedge fund participation is now very widespread, and it's evolving with spin-outs, with different strategies of those hedge funds and privates. And the family office world is now quite active, whether it's standing up a direct practice for the first time, or it's allocating more aggressively to existing and or emerging managers. It's clear that there's this attractive pull into the venture ecosystem. And then you're also seeing it from non-traditional asset managers. These private banks are starting to play more in the category and creating these fund solutions around their clientele, to get them involved. And so all of this, I think if you boil it down to what it means for our role and who we each are in the ecosystem, is it's kind of a moving target on the capital market side of the equation, and who is competitive, who is friendly. And it comes back to this fractionalization comment I made earlier. Who are you working with on any given deal? Are you creating community, an ecosystem around your founders and around your portfolio, or is it more of an elbow match to try to win allocation? And certainly you do see more of the competitive dynamics play out in the later stages. But I think when you have competition, you end up getting a better end product for the founder. And so I think when you look at Tiger, fast capital that is relatively cheap given the valuations that they're willing to price their portfolio companies on, that's a great product for a founder. Is it one size fits all? No, it's not. But for some of the founders that want to raise that quick money, have a Tiger brand, that's a great product. I think where we fit in is aligning ourselves with the founder as fellow entrepreneurs. We're a 3-person team, and every investment we make really matters. We roll up our sleeves. We are extensions of BD teams, of talent acquisition teams, of corp dev teams, in a meaningful way, where we're really hands-on in the spaces that we think we can help. And so I think that's the takeaway, is what is the product that we're bringing to founders, because that's really the ultimate target that we're looking to serve.
At Impact Venture Capital, we spend a lot of time with the corporate venture market, and I think that's another aspect of investment that has grown significantly in recent years. And I think if we look at the historical context, there has often been a fraught relationship, perhaps, between traditional venture and corporate venture arms. What we've done is really bring those two things together, and we've seen a huge growth of corporate venture participation at earlier and earlier rounds. We've had the likes of Yamaha and Baidu and a host of other corporate venture arms join us, even at the Series A level, which I think is a newer phenomenon. What that does is it also, to Joe's point, helps with that ecosystem around founders. When I stepped out of an operating role and looked at venture firms to potentially join, I remembered very vividly as a founder that every venture fund I ever talked to, and we raised $110 million at Topia while I was there, so I talked to a lot of them, sort of says, we help to build an ecosystem and we do a lot of value add, et cetera. And my experience is that has a wide range and often is very limited. What I like about our model at Impact is bringing together the corporate venture investors, bringing them into the business, helping the entrepreneurs to get feedback from them, and also support go-to-market activities and subsequent introductions is really, really valuable when you put on your entrepreneur or operator hat. So both a new addition to capital in earlier stage rounds, but also by extension, I think more access to customers, go-to-market support, et cetera, for entrepreneurs. And at Impact, we saw this model work very successfully in our first fund. We're on our second fund right now, actually currently raising it. But our first fund is already done well, and we've had 2 exits actually to date in the first few years, both of which were achieved through that corporate venture partner network and significant follow-ons and go-to-market support for our entrepreneurs through that corporate venture network.
Hey, Jeremy, let me just jump in here 1 second, okay? Brynne, that's really great. I think that's a fantastic niche to be in, and it's really exceptional. So I was just hoping that we get more differentiation between what a venture studio is and a venture capital fund, and also what a venture studio is and an accelerator from you guys, because it seems like you're kind of like all on there. And also the relationship of if there's any tangible relationship at all between IRR and diversity. So I'd love to get some kind of perspective on that. And that's 1 and 2. And I think the third one is, if you're doing early stage investing, I think it's difficult to always get the next round. Do you feel like valuations are high? you know, do you feel comfortable, you know, do you invest in multiple rounds? Do you feel comfortable with the companies that you have upstream, the other funds who you may partner with who invest, you know, in up rounds, et cetera? So if you guys can just address that, that'd be really great.
I know on number 2, Brynne, I think you had some data from a study you'd been involved in that maybe you could share in terms of the performance along these against these DEI metrics. Is that right?
Yeah, my partner Eric Ball, who was actually previously on the SPAC panel wearing one of his other hats, participated in some research out of University of California, Berkeley, looking at the impact of diversity on outcomes. And what we found in summary in that survey, and I'm happy to share this with you, Marty, so you can get it out to the network, is that actually sort of non-traditional or more diverse founders outperform the traditional profile. So female founders, older founders, et cetera, specifically were 2 categories that were looked at in that research.
What are the metrics? Is that like going public or revenue or IR? Or?
I believe it's valuation growth and achieving exits.
Okay, yeah, I would love to see the data. So.
Yeah, I'm happy to, I'll send you, there's a white paper actually. Eric and I will send that to you. And like I said, you can circulate it to folks in the network. It's very powerful reading end to end with all the commentary as well.
I was going to say, I think there's also a Goldman Sachs report that came out about women fund managers. I can try to dig that up, Marty, and send it over. But I think it was actually talking about women in more institutional funds that actually performed better than their male counterparts. I just remember seeing the Goldman Sachs, but I think that's
like all funds. Sylvia.
Pardon me?
Is that venture only or is that all funds?
I think it was all funds. So it was a more macro perspective outside of just venture.
Hedge funds, et cetera?
Yes, exactly.
Interesting. Yeah,
no, I can maybe jump in on the studio versus traditional venture and the studio versus incubator, and then maybe Priscilla, who already spoke very well to the kind of value, can jump in. So, I mean, I think a studio versus an incubator, first of all. So, first of all, I will kind of qualify this by saying that every studio, every incubator you speak to has a slightly different model. So there is no one definition. But in my mind, an incubator is really there to take existing founding teams who have a specific idea that they want to work on. And an incubator program generally gives them a specific amount of money and a very specific set of services for a limited period of time, and then sends them on their way. So Y Combinator being a kind of classic example of that, obviously Antler as well. And they take a relatively small percentage of the company for doing that. In a studio model, generally, we are developing our own ideas. So we're identifying unmet needs, we're coming up with solutions, and we are building them essentially as a co-founder. And then once we get to a certain point with those ideas, we bring in a external co-founder and we spin the company out. So we're very hands-on involved, very hands-on in actually building the company, building the business, engineering, design, business development, growth. And we therefore take a higher percentage of the company, but of course we believe we add a lot more value. Now, the truth of the matter is that between those two, there are different organizations that call themselves studios or accelerators or builders that exist at every point on that spectrum. But that's kind of broadly speaking the model. And I think what also distinguishes them sometimes is the kind of founders that they focus on. If you take Y Combinator, you know, I think anyone can apply, but they definitely take fresh founders who have never done a startup before. Our model is much more to look at people who have some startup DNA, who we believe have a reason to succeed by having been involved in at least one startup before as either a founder or a early employee of a startup. So I think there are kind of different selection criteria. I know, Priscilla, if you want to add anything to that.
Yeah, I mean, I agree with everything that you said, and it's true. There's so many one size fits all. Everyone has their own unique expertise that they can bring to the table. There's an idea of incubators where you're working on companies from scratch, or you just have the studio where you have the value add to help bring your own, I would say, kind of pizzazz and get these companies to that next level. I think what would be really interesting is that we've seen the evolvement from what these operating studios or operating companies to now kind of merging into funds. Before there were fund sponsors, and I think now what's even more so relevant is that there's the ability and flexibility of time. There's the opportunity to really dive in on specific expertise sectors. And I think at the tail end of it is, we're starting to see, Joseph mentioned this earlier with Snowflake. So there were these IPOs that are happening within the SPAC world that have come from really, really early incubator and studio ideas. So I think we're going to start to see the value add. And again, studios aren't for everyone, but it can certainly lend a value add to most folks.
And then to bridge that, Marty, I think with your last question around investing in multiple rounds, I think when you look at the investment model, accelerator, foundry, or later stage investment, early stage investment, it's you going through the exercise of building the fund model and realizing what the drivers are. I mean, you tell me the incentive and I'll show you the behavior. As you build a fund and you build your strategy and you understand with the types of returns that you want to provide for your LPs, the types of relationships and deal flow access that you have as an investor, you have to index towards where you can drive that outcome. So for us, which is perhaps against the grain relatives to the earlier stage focus with the broader panel, we're investing across the growth stage life cycle. And so we have a view that we can invest in both primaries and secondaries. We've done that with a number of our existing portfolio companies. And it's really providing flexible growth capital as a solution for that founder to tap into what they need at the right time. But it is supporting through that life cycle. And I think that gives us an interesting lens into venture is so fundamentals based. How is the business performing itself? But we can layer on the technicals of how is the company performing in the broader capital market when they go out to raise, when there are secondary transactions that occur. And that then gives us an additional lens to discern what our entry looks like from a portfolio management perspective.
Let me just jump in here, Joseph. And I just have to agree, secondaries have been so important to venture capital. I mean, after the crash of 2008, it bailed out many family offices, et cetera, who then later on, they reaped some rewards and stayed in venture capital. They would have gone out otherwise. And of course, this huge expansion in venture debt, which didn't really exist as much 10 years ago. So I think it's really interesting and fascinating. I still want to get back to just gaps, in venture capital that we've seen in the past, which is next round funding. So like Series B, Series C, et cetera. And maybe you guys can address, how you figure out next round funding or how you are looking at next round funding, because so we've hosted more than 500 venture capital firms with our group, and it's always been interesting to see, that many of the seed investors are, once they've had a little bit of success, they look to raise a growth fund because they're looking to, sustain some really good companies that they've created or invested in. So I just wanted to get some perspective from you guys on how you intend to bridge that gap. And just, I know that I think it was Sylvia earlier who was talking about how, venture capital has spread out, all around the world. And that's probably true. If you go to Miami, there's a ton of startup, seeders. Austin, Texas is the same. But when it comes to getting Series B, they all come to Silicon Valley or New York. There just aren't a lot of big players there. So hopefully, can you guys address that some?
I can speak to that because actually CerraCap, unlike a lot of other early stage firms, we do not do what we call the spray and pray model. So I think a lot of times in early stage, it's all about diversifying your portfolio. You invest a little amount in a lot of companies. And I think that's where we go back again to that authenticity, that definition of value add, and is it actually tangible and measurable? So because of our unique model of sales and scale, we actually have a very concentrated portfolio. And I can tell you that, especially for our fund too, more than 50% was reserved for follow-ons. So we do like to see our companies throughout. We like to lead rounds. And when we choose our portfolio companies, we definitely follow them all the way through. And, actually one of our fund one companies is about to go SPAC and is, has been valued at over $1 billion. And I think that speaks to the success of our company. It's called Viome. It's the world's largest human microbiome database. And that speaks, I think, to how we've been able to follow through from the first check-in all the way to pre-SPAC.
Yeah, I think SPACs may be broadening the outcomes. So,
hey Marty, this is Brynne. I'll share a few thoughts. I think so. At Impact Venture Capital, we like to be the first institutional investor. So generally, that's the seed or the Series A. So obviously, then the entrepreneurs and the companies need to raise their subsequent rounds. We often do our pro rata in the subsequent rounds, and for companies where we have high conviction or they're doing well, we'll often do our super pro rata. But I think we also really see our role as board members and as early investors in helping those companies to make the connections to support their subsequent rounds. So we do that both through our corporate venture network, which is institutionalized. We have an annual event. We have quarterly deal flow calls. We have a TV series where we bring entrepreneurs and the corporate venture investors together, but also just through our venture partners and our general partners networks, making connections for those entrepreneurs and making introductions and really being champions of the companies where we do have high conviction. And quite frankly, I think that that's a really important role of an early stage investor, is helping the company with their growth plan and the execution of the financing to enable that growth plan.
That's really well said. I think it's all about the composition of that round and in line with where the company is and what they're looking to accomplish in their next phase of growth. If they're looking at international expansion, perhaps we can tap into our LP network that comprises some international investors. If they are looking for expertise in a specific domain, whether it's our corporate network or it's some of the LPs that have made their money doing something similar, our founder network, and then shaping the round based on what they need. If this is more of a buzzer beater pre-IPO round, you'll typically shape it with hybrid funds that have both public and private books. I think, Brynne, you've talked a couple of times about the corporate partners. I mean, that's such a great piece of the equation that you can tap into as a founder if you want to be well aligned with some strategic partnership. But I think all in all, it's a case by case scenario, and it's tailoring the financing solution, equity, debt, secondaries, whatever it may be, to what that team needs to get to their next phase.
Can I just jump here one more time? Marissa Hoke, are you there? Do you have a question? You want to unmute? Marissa, you raised your hand. Was that an accident? Okay. Ashkan had asked a question. Jeremy, did you get those questions from Ashkan? Did you review them?
Sorry, it's Marissa Hoke. I apologize. I didn't mean to hit the hand raise. And this is a very interesting, wonderful discussion.
Do you have a question? No? Okay.
No, I don't. I didn't mean to hit that. Sorry.
Okay, no worries. Ashkan. Jeremy, did you read Ashkan's questions about your themes and how you pick your themes?
I did, and I responded in chat, but I'll answer again in case people aren't monitoring chat. So, I think one of the great things about the way we do things at Platform is we are able to use our network to both crowdsource and crowd filter unmet needs. So we'll often start with an unmet need that we have identified, and the first thing we'll do is we'll go out to our network and say, hey, do you agree this is an unmet need? And often, in that process, we'll discover either there are some startups that have got some significant traction already, so it's kind of too late to enter, or we'll discover there are other ways of framing the unmet need or finding a solution. And we are sort of the antithesis of stealth mode. So everything we do, we build in the open. So if you go to our website, you can actually see all the unmet needs we're tracking, and all the companies we're building. And it's a very sort of open process. And I think that's really, really starting to get some traction, just because people love the idea of just participating and seeing these things develop. So that's how we do it. And I'm happy to, you know, share more. I shared my email in the chat if anyone wants to reach out.
Right, I think Rob Colorine had a question. Rob?
Hey, Marty, thank you. Can you hear me okay?
Yeah, hear you.
Great, great. Yeah, thank you all for getting together and addressing this. I guess for the panelists, given the sort of the mixed of starting dates around COVID for the states and the like there, how do you hedge against overpaying? Some companies are looking at tailwinds in exits in COVID recovery. So from the buy side, how do you hedge from overpaying and are the mechanisms for sort of a safe structure?
That's an awesome question. I mean, this market is so rich, and we're seeing, you know, you see the seesaw go back and forth between the public market overvaluation versus the private market valuation. Right. We're seeing the retreat of some of these super high profile software companies that are in the public space in terms of their next 12 months revenue and their valuation multiple against that metric. Yet you see some of these high flying private companies raising private financing at 25 to 80 times their next 12 months revenues, or, you know, they're a multi-billion-dollar company without any revenues to speak of. I think what's important is to have a macro view on the topic at all times, to understand what a comp on the public side or an M&A transaction comparable is and what it is not. It's not a perfect evaluation of value. It's one piece of evidence to consider in evaluating value. I think the other piece is, it kind of comes back to this outcome math that I was speaking about earlier. You really have to understand what you need to see as an investor to believe in the next phase of that business and achieving the outcome that you need to see as a fund manager for your portfolio and for your LPs. And it's really having the discerning eye and focusing on what needs to happen to get to that outcome from a modeling perspective. But there will be instances, countless of them, where people will reflect on these years that they overpaid. But sometimes it makes sense to overpay. If you overpaid for Zoom stock or Snowflake stock in the 3 rounds prior to their IPO, you did fantastic, and it was worthwhile to do so. You know, other times it's not such a happy song.
Hey, Joe, can I just address? I just want to kind of go off on a little bit of a tangent from what Rob said. But it's not just that you're overpaying for the company. The talent is changing, right? I mean, the fact that COVID has hit the world has made every business want to become internet business of one sort or another. So you're seeing this, you know, massive job hunting for people that could convert storefront businesses into, you know, virtual internet-enabled businesses, right? So it's really changing the world. I was talking to a software developer at a company. He told me that you know, they're going to be they don't want to start working at the office until January next year, and they're trying to make it like permanent where it's optional.
Talent markets are very liquid right now. It's much easier to be poached as a top performer if, you know, you're hanging up the phone with your boss and then the next call you take is with a recruiter versus the FaceTime aspect. And so we're seeing talent liquidity between venture funded companies at an all-time high.
I think the flip side of this, though, to consider is that access to talent is also greater and broader than it's been. You know, we're coming from a world where most startups were in one of 3 cities, principally the Bay Area, but, you know, a bit of New York and Boston or LA as well. And the talent bases were often in those cities where those are very expensive cities, salaries very, very high. With the virtual world, we have access to a much greater global talent pool. And, you know, in many cases, that means that salaries are lower as well. So there's 2 sides to this coin. But I think the thing that it does bring up for a lot of entrepreneurs, which is important to dig into as an investor, is the ability to manage a virtual and distributed team, and in some cases a cross-cultural team. That is a different type of management. And I think it's important to ensure that teams are aligned to that culturally, and the leadership of the business it has the communication skills and sort of the plan for doing that successfully.
Just as an insight, I used to run JP Morgan Chase's offshoring group, or one of their groups. And so we offshored 50,000 people. And what we found is that, you have these initial savings, but then the cultural things make it very expensive over time. And then you lose something from offshoring labor.
Yeah.
Something intangible that you lose, right?
Yeah, I mean, my business, in my prior life was a talent mobility company. So, 12 years ago in business school, I saw the market going this way. Obviously did not foresee a pandemic, but first saw the market going this way. And, what Topia, the business I founded and ran for 9 years as CEO, does is provides a software platform for businesses to manage distributed and mobile workers. So I spent a decade talking to people about this and wrote a book about it. So, when I look at companies, the leadership skills, the culture of early stage businesses, that is always top of mind for me, particularly since we've all been shocked into it so quickly with COVID.
I think COVID, Marty, this COVID migration is a huge transfer of wealth geographically that I think many people still don't really realize. I mean, just the fact you've got all these Bay Area workers who are now moving to all these tier 2 cities like Bozeman, Montana, and the real estate prices are tripling. It's just an amazing transfer of wealth. And I think it's going to continue. And that's definitely one of our themes that we're tracking is how does COVID migration just impact where the wealth goes in the US and around the world?
Yeah, I mean, that
might and I think, that's
time, guys, right? Because people retire, all these people who are in California, public pension employees retire to Arizona, right? And that money doesn't get recycled back in California. So, and that's a far bigger number than people moving to Bozeman. So, but I see your concern. And then just to address the, there's no doubt that when you hire in other cities that you're getting people that are, have some talent, but really there's only like 8 or 10 cities that have great talent, right? I mean, because you're talking about really with fantastic educational institutions. And so you can name them on 2 hands, where they just have like Boston, lots of great schools, Philadelphia, right? So you can name them. A lot of people talk about Miami, but I don't think the university, and my brother is the dean of school of education here in Miami. It's not top talent there. I mean, he's a great guy, he's really smart. But,
well, having gone to Yale, I would dispute that, Marty, because I don't think anyone would say New Haven is a city with super tech talent, but I would challenge you that New Haven has as good of a school as Boston does.
Yale's a suburb of New York. Anyway, great.
I didn't let that pass.
So Jeremy, why don't you continue? I think we got about 5 more minutes, and go from there.
Happy to. Now you've broken my flow, though, Marty. So I think we had a couple of other topics I think that are interesting to the panel, and I know Brynne, you sort of touched on this beforehand, but it's very hard to get away from blockchain and crypto as a trend in VC for 2021 and beyond. Anyone want to kind of jump in on that as a meta trend, and kind of how you're thinking about that as an enabler as blockchain continues to develop?
I'm happy to jump in. I was just gonna give someone else the chance. But I think if you look at blockchain and crypto, similar to AI in many ways, which is where we focus at Impact, is I think many businesses of the future will have components of both of those things. Many businesses will be built on blockchain. Many businesses will have an AI at their core. And many businesses, depending on what they are, as particularly consumer-facing ones, will use some form of a coin or an NFT within their business model. So I think, the way we're looking at it is looking in the same way that we would with other technologies, looking for a clear differentiation in the way that the technology is applied, tackling a big market and disrupting a foundational industry. That's kind of our thesis on things. I think looking at the talent is the second order question about this. I was literally having this conversation with a CEO this morning who's building up his tech team and building a really interesting art tech business. It's called C.me on blockchain and based in NFT technology. But just mapping out the talent plan, which blockchain do you build on? How does that drive your recruiting strategy of the business longer term? I think all of those questions are really important in early stage businesses.
Yeah, I would also agree with that. I mean, we had back in 2017, we raised one of the world's first securitized token, which we used that money to launch a blockchain incubator called Science Blockchain. And to Brynne's point, on the consumer side, it's really trying to find the functional component and how that actually translates into real businesses. One of our companies that we had looked into and have been working with since 2018 is a company out of New York called Real Blocks, and it's a platform to provide liquidity to private REITs. They've since partnered with JLL, about to onboard Neuberger Berman and a number of other highly notable financial institutions, and I think that's one that we'll start to see tangible outcomes from. And then on the NFT side, what we're starting to see, and this news will likely come out next week, it's one of our media companies called Mammoth, and they have a solution called Promotely, in where they're working with brands on Snapchat, they're Snapchat's exclusive partner, and TikTok, whereby you can actually use NFTs to gift. So GIFT, not the gifts that we're used to seeing in sharing. But I think we're going to start to see a lot of these use cases, and what we've seen obviously with GameStop and kind of that whole Reddit and all these meme coins. I think we're going to actually see real tangible businesses come out of it, and it's only going to be a matter of time. So I'm excited to see what is going to play out.
Well, great. I think unless anyone else wants to jump in on that one, that is a good place to break. If there are any final questions, now would be a great time. I know, Bill, I see your question. I think you're looking to connect with Brynne, so I think we can, I'll make that connection for you if that's not happening. If not, if nothing else, back